When's the next Bank of Canada? When's the next inflation print? That could cause anxiety in terms of the direction of where rates will go. But it's your risk tolerance in terms of all, some people like to ride roller coasters. It's a lot of fun. Some people don't.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
Well, it's been a roller coaster last couple days, Mr. Bruno. Thank you so much for joining us. Despite the snowy weather just outside of Toronto, you are still with us here today. I mean, I don't know how you guys even live on the East Coast when it's snowing on April 11th of 2025. Are you doing okay? You didn't hurt your back out there today, did you?
No, there was no. At this point in the season, I let Mother Nature take care of the shoveling. I know it's going to go away. It's it melted away. It's supposed to get to 6 degrees. So good news is we got a little bit of a 6, which is not bad. The bad news is it's who knows? It was such a rough winter. It'd be nice to get a beautiful spring.
No doubt.
Yes,
no doubt.
As you indicated, I am ready for golf.
I know.
But the golf course isn't ready for me.
It's okay. The West Coast will be ready for you when you're ready to come here. In the meantime, we're playing our other most favorite national support at this point right now. And that national support right now is talking about what the heck is happening in the rate market and how it's going to impact Canadian real estate. And who better to bring on? Obviously, I'm going to reintroduce you because maybe not every single person has had a chance to be introduced to you yet, Mr. Bruno Valko, the President of Sales with RMG Mortgages, a fantastic lender that we love to support, and an even better guy. So really excited to have you back on this show in this episode. We joked earlier before we got rocking and rolling that I like to bring you on because it's all fun and games and positive and happy rainbows. But you said you're probably the least or not that person at all. What's making you feel that way right now, Bruno?
So basically, and I think it's not just me. So when you look at what I'm looking at times, I'll look at Jerome Powell. So Jerome Powell is a great example. So he does his minutes for the Fed, and he's the chairman of the Fed. And when he comes up and he talks, first of all, the last 2 Fed meetings, they've held their rate steady at 4.5. So they didn't move. Now, Bank of Canada, which is meeting on April the 16th, has dropped consistently, be it a half or a quarter, in their previous meetings. But the last 2 meetings, the Fed has held steady. And we always have to understand that even though we've been dropping, which is the good news, the bad news is we are reliant on the U.S. in terms of the direction of our bond yields, our 5-year bond yields. They pretty much mirror the direction of the 10-year Treasury. But we also are kind of tied at the hip because we export so much product to the U.S. 70% of our exports go to the U.S., that we really have to watch what's going on in the U.S. And Jerome Powell will say the words uncertainty, volatility, things like that. And things like that don't make me comfortable because, like everybody, I'm sure your clients on this call and your folks on this call, they like certainty. And when they have some sense of certainty, be it good or bad, they have a sense of certainty. But right now, there's not much of that. We don't know if things will be great in 6 months or things will be good in 6 months, I should say. Maybe down there, they might be great again. But nonetheless, we're looking at Canada. And that volatility in the United States does have ramifications to what's going on here in Canada. Tariffs on, tariffs off, aluminum and steel, now cars. I mean, all that stuff, especially here in southwestern Ontario, as I'm sure in British Columbia too, is there going to be a tariff on softwood lumber? What is it going to be? Is there not going to be one? How long will it last? Will it last 3 days? Will it look at the reciprocal tariffs? They came on Wednesday, and then they weren't on. I don't know. They lasted a week. So all that uncertainty is causing a lot of people within Canada as well to really second guess whether or not should now be the time to buy. I'm not quite sure. I work in a manufacturing plant, so that uncertainty and you know, but we can talk about it later, but we talk about the 10-year treasury in the United States moves, well, we get pulled. Our 5-year bond yield gets pulled with the 10-year treasury. And if it goes up or down, we tend to go up or down. And I got charts and graphs that show that. And right now we're being pulled up by it, even though we didn't have a very good jobs report on Friday. And much of that is because of this massive sell-off of 10-year treasury. So the 10-year treasury, for those of you on the call that don't know, is where Americans price their 30-year mortgages from, which is their kind of flagship mortgage. Our flagship mortgages, of course, 5 years. We price off the 5-year bond yield. And our bond yield gets pulled by that 10-year treasury yield, and that's causing some grief this week. And some lenders are moving their rates upward, as I'm sure you've already seen.
No doubt. Yeah. And well, let's go back. There was a lot to unpack there. We kind of fast forwarded through a few things. A question I have for you, Bruno, is since you've been involved in the industry in multiple different capacities for 30 plus years and seen a lot of different economic experiences, I mean, just the last 5 years alone has been one for the books or a time frame for the books here. Have you ever seen or experienced a time with this much volatility outside of 2020 in recent years, like that you can think of?
I think that even 2020, we didn't have a lot of volatility. I think that you and I would both agree that in 2020, we were pretty certain that rates were going to come down, right? We were pretty certain there was an emergency rate cuts from the Bank of Canada. So there was certainty that rates were going to come down. So when I talk about the uncertainty of rates, I would go back to the Great Recession. So during the Great Recession, 2008, 2009, there was a bit of uncertainty at that time because we didn't really know to what impact would that have on Canada. And we had rates priced very high. The spreads on rates were high. Remember the discounts on variable? They had prime plus mortgage rates. So there weren't even discounts on variable. Why? Because the financial institutions were uncertain. At that point, there was a time where financial institutions didn't like lending to each other because of the Bear Stearns and Lehman Brothers and all that stuff that was going on. So there was a ton of uncertainty back then that I would kind of relate our current situation to. But I would say this time around it's a little bit worse. And the reason I say it's worse because we were pretty, like with CMHC's backing and the insurers backing, be it Sagen, there at that time it was Genworth. I mean, many of our mortgages were insured and we didn't really get that badly hit in terms of our real estate values back then. Whereas in the United States, it was a bit different. This time around, like we really don't know what things are going to look like. And it's like when people make predictions, it's impossible to make predictions. Jerome Powell can't make predictions. Remember, the chairman of the Fed is sitting there saying, like, I don't know what the ramifications of these tariffs are going to be. They're data driven. So when you look at the inflation data that the U.S. had, that's rearview mirror stuff, right? So that's March's inflation. And we didn't have the tariffs to the extent that are now being released onto 145% on China. Your number one importer, you're slapping them with 145% tariff. I mean, that is obviously going to have ramifications throughout the United States. And I make a joke, and I'm not even sure that you tell me if this is a joke. And everyone on this call that is close to a border town. I grew up in Windsor, Ontario, right? Many people would go across the border and they'd go get gas and they'd go get beer and they'd go to the shopping centers and so on. And I'm sure, I know that people in Vancouver head down to Northern Washington, Toronto, they head to Buffalo. Is it going to be the other way around? If your Nikes are going to cost you $400 and you can get the same Nikes here for 150 Canadian, will you cross the border to buy those? Now, everyone on the call, you got to declare that stuff. The Americans do.
caveat. Yeah, I know.
The Americans have to declare it, I guess. But the Americans were never worried about anyone shopping out there. It was the other way around because Canadians would go shop in the United States. But with all these tariffs, and you hear about it and the cost of goods going up. I mean, if we don't have this with Vietnam, remember, that's your Levi's, your Nikes, and so on. But China also, of course, toys and products and cell phones and on it goes. I mean, there might be that, get ready, you border towns, you might start booming with retail shopping. It'd be interesting to see the data for Canadian retail sales in May. Should these tariffs actually be implemented, who knows what's going to happen? Again, that's why it's difficult to make a prediction. All of a sudden, the tariffs go from 145 to zero. There's a deal cut. Something happens. There's a social media post. I don't know what's going to happen. Nobody does. But if they stick at 145%, and then there's 10% across the board on every other country, it'll be interesting to see the retail sales numbers in the US and the retail sales numbers in Canada.
So what the people, I mean, that's an interesting way to look at it. And I wouldn't say you're wrong. I mean, just with the exchange rate recently, we've experienced, nice mug, by the way, we've experienced a lot of folks heading up north to spend more time vacationing in Canada, whether, I mean, I don't know if that's been the last week or two, but it certainly was a trend there over the fall in places like if you're in BC in the interior, such as the Okanagan, they saw a massive uplift in Americans coming in to go to the ski resorts and so forth. And I think they're suspecting that in the interior where there's a lot of tourism, that they're going to see a lot of people coming in and spending time at the lakes and so forth. Plus, Vancouver is expected to see a big influx this year for tourism, which will be a welcome return back. But that doesn't really fix some of the primary issues that we have in Canada. And I'm going to digress for a second here because quite simply, I want to make sure to track over to what is it, Canadians' favorite pastime, which we're talking about today, which is going to be mortgage rates and real estate. And the question that I'm getting every day right now, well, we get this question every day anyways, but it's certainly ramped up, is one that we spoke about with millions of Canadians coming up for renewal in the next 12 to 18 months, is what do I do about this upcoming mortgage renewal I have? The second point to that, Bruno, is we witnessed over the course of 5 days, bond yields, which if you're listening to this call and you don't know this already, there is a very large correlation between bond yields and mortgage rates, particularly the fixed rate side. We witnessed basically a shockwave where it went down and up with, I think it was 30 or 40 basis points. That's 0.3 or 0.4% in days, which is not a normal occurrence for anybody listening to the call, which is causing lenders to react quickly and rates to change. And I think what I'm noticing is that because the news gets out weeks and days later, most people are shocked to hear, what? My rate's not going down now? What do I do? Do I lock in early? Do I refinance early? What are we telling Canadians right now? What should they be thinking? How do they react to this?
I think that Canadians need to, if they are following mortgages and they are concerned about their mortgage interest rate and their mortgage coming due, obviously I always suggest that you contact a mortgage professional well in advance to discuss your options in terms of what you have, and as well as what is your risk appetite. A lot of people, do I go fixed? Do I go variable? I mean, look at the variable rates right now. You know, Alex, they're starting to go up thanks to that volatility in the bond market. We were down to 2.41 a week ago on the 5-year bond, and we're currently, last I looked, at 2.87, something to that effect. So exactly 47 basis points in fluctuations. Now you got fixed rates kind of going up. So, there was that opportunity, the high ratio insured and so on. You had that 399 that you were able to get. And now all of a sudden, if rates go up, you don't know. So the people that, don't really like following this volatility and just want a low rate, maybe the fixed rate is good for them. Now, if you're willing to take the risk, because remember, we talked about the Bank of Canada. So the Bank of Canada is going to meet on April the 16th. There's a number of things that are working, in my opinion, towards the consideration that they're looking at a quarter cut. I never make predictions because anything can change. One social media post and everything changes. So there's no predictions here. But you have the job numbers in Canada that came out on Friday that were weak. Remember, the central banks have two mandates: maximum employment and 2% inflation. So in Canada, we're at 6.7 unemployment rate. That's elevated. So the Bank of Canada is considering the way to bring that down is to bring rates down. The other thing is the low inflation rate. So in the United States, their inflation rate came down to 2.4. It's not at 2, which is where they want to be, but it's at 2.4. Much of that is thanks to energy costs coming down. But nonetheless, the United States inflation rate is important to Canada because, again, we follow them very closely. Canada's inflation rate comes out the day before on April the 15th. But I'm talking about all this stuff because if you take a variable, do you really want to do all these things? Concerned about when's the next Bank of Canada? When's the next inflation print? When's the next job print? These things I follow because I enjoy it, but that could cause anxiety in terms of the direction of where rates will go. And again, the U.S. Fed hasn't changed rates twice. They're at 4.5.
Right.
We did change many times, and we're at 2.75 on the Bank of Canada rate. And again, on April 16th, we'll find out more. But it's your risk tolerance in terms of all, some people like to ride roller coasters. It's a lot of fun. Some people don't because they get sick with all the ups and downs. And maybe if they can afford the fixed rate and they don't want all this anxiety, because even if they come down, they might go up. And we don't know what sort of news. We don't know to what extent we reply to these tariffs with tariffs of our own. So if we have reciprocal tariffs against the United States, that could be inflationary. And if that's inflationary, remember the 2% the Bank of Canada mandate, that could cause problems for the Bank of Canada if we retaliate with too many tariffs and we see inflation rearing its ugly head.
And I think, I posted a video about this about a week and a half ago that, hey, most Canadians don't realize interest rates could go back up. And it's not to say that it's not a threat to say like, hey, it's going to happen for sure.
The fixed rates are now going up. You're bang on. I mean, today I got rate sheets and I'm looking at rate sheets and the competition out there, and we're seeing some rate increases out there. I'm sure you've seen the fixed rates go up.
Well, right? That and potentially BOC for that matter. Speaking of rates going back up or down, the part that I think is causing the highest amount of angst that I'm seeing, Bruno, and I know you're talking to brokers, so you're getting it secondhand, I suppose, but you might be hearing it from other people, is the stress that's coming in is causing, I think, people to make decisions based on a short-term play versus a long-term strategy. And here's what I mean by that. I don't believe that the average Canadian, unless they're working with an educated professional who's advising them and taking the time to walk them through it, I don't believe that the average Canadian knows that there's actually a difference between mortgage X and mortgage Y, RBC versus RMG or any of these different lending institutions. And with the market changing with this type of volatility, I keep asking myself the question, if it could change this fast up, what would stop it from changing this fast down again? And the answer is nothing. Like there's no reason that things couldn't also come back down. I mean, there's lots of reasons, but there's possibility that things could come back down again. So what do you think it would take for Canadians to actually start paying attention to the other factors of the decision making and making decisions based on strategy? Like, how are you advising people to take that approach in this type of climate besides just taking a fixed rate mortgage? Like, what are you thinking?
Well, from my perspective, I deal with mortgage brokers. So it's up to the mortgage brokers to provide those options for their clients. Right. But when I do talk to brokers, I talk to them just like I've said. It depends on the client. I mean, if you're happy with the payment, remember, a lot of people don't lie awake at night worried about the interest rate payment. They lie awake at night worried about their overall payment.
Correct.
And if we're talking about mortgages coming due and people refinancing, and if you're consolidating debt and you're lowering your overall obligation, maybe you're cleaning up a car loan, maybe you're paying off a line of credit, you're putting it all into one mortgage. Now, all of a sudden, even though your rate used to be, call it 249, and now say you get 449, but you've consolidated some debt, you paid off a car loan, you paid off a credit card, and now overall, holistically, your payments are down $700 a month, even though your mortgage rate has gone up because you took out a car loan, you paid off a car loan, you paid off maybe a line of credit, and you've consolidated that debt. Again, you're not lying awake at night worried about 449. You're lying awake at night about, I got a car loan payment I got to make. I got this line of credit. I got my mortgage. Even if your mortgage is at a very low rate, if you have all these other debts, that could be your anxiety. So if you clean all that up, get it into a fixed mortgage because you don't want all that anxiety. You have the equity in your home to do it. You've consulted with a mortgage professional. You might be better off with a higher mortgage interest rate. You know what I mean? You're not going to get 249 these days. At least I don't think so. I don't see that out there. That's why I'm kind of saying 449, 4%, whatever. These rates change, but to your point, they could come down. Everyone wants predictions, but if Jerome Powell can't make predictions, how can I?
How can we? Yes,
I can't.
the guy who's on the ground floor dealing with the lenders all day long. Well, so that leads me into something more, of an economic question, and this is where again we're trying to look forward with many Canadians and many people reaching out to me. I mentioned this earlier, like I showed you, or I can show you right now on my Instagram channels, on my YouTube channels, and on my emails right now. I have at least 15 people in the last 24 hours who have reached out and asked some version of the question. My mortgage renewal, as I mentioned, I know I repeated this, but I'll repeat again, is coming up in December, in January, like within the next 12 months. Alex, what do I do right now? How do I even approach this? And we talked about, obviously, you might have some high interest debt or some other things that could be worth consolidating and looking at the cost of doing so versus keeping it as is. But again, it's just like, because of the amount of news that's coming in right now, that question is weighing heavily. Notwithstanding this fact, Bruno, Canadians are also concerned about losing their jobs. And when they're coming up for renewal and they might need to refinance or change their payments, I think people are like, this is my first renewal. What do I do? And what do I lose my job? This is a serious amount of angst created in the marketplace. And we do have ways to approach this conversation, but I'm just curious from your perspective as to just, if this is something that you're hearing. First of all, if you're hearing this all over the place, and strategically speaking, what you're suggesting people consider in this market, aside from what we discussed before.
Well, my mortgage came due April 1st. So I can tell you that right out of the gate.
Let's talk about it. There we go.
Now, I'm old enough to have had many renewals, but my mortgage came due April 1st. And what I would encourage your listeners to do is, even if your mortgage is coming due, if you are having any anxiety, and you're sending that email to your mortgage professional, I would suggest, number one, first and foremost, have a meeting, face-to-face via Zoom. Let's do a mortgage application. Let's find out, what did you pay for your home? Do you have one mortgage? Do you have a line of credit? What's your situation? Because people don't understand, to your point, that they have that opportunity potentially to make their overall debt situation better. They're just saying, okay, I'm at 2%. And oh my God, my mortgage is coming due, and I'm looking online and the best rates I see are 4%. Well, what's that going to do? What's that going to do to my payment? I'm already kind of going day to day. I got my kids' hockey, soccer, whatever. I got all these things going on. How am I going to be able to afford that higher interest rate? Right? And that's the opportunity you have, is to take a full application, and then you'll get a sense. Like, you'll look at the credit, you look at the equity position, you look at the property, and you talk to them about their job and all their income and so on. But there could be an opportunity to put them in a better situation. And some people will say, well, you're going to do a 30-year RAM. Is this like the never plan? Well, what I always argue back is, well, if you bought a house 5 years ago, you probably took a 25-year RAM, say. You got 20 years to go. So even if you consolidated your debt, then put them on a 20-year RAM with all the debt consolidated. It could still, on a payment basis, be lower than your car loan, line of credit, Visa card, and mortgage combined, even if you did it on a 20. So you're still back on track to paying your mortgage off in 20 years. You've just increased the balance and you paid off your outside debt. Alternatively, of course, as you know, you got to, based on qualification, of course, you can do up to a 30-year RAM if you wanted the lowest payment possible on that.
Yeah, that's well said, and that's a good point, and something that we talk to a lot of folks about right now. It's not I think there's like just a general mindset right now for people that, oh man, if I go back to that 30-year amortization, that's just going back. I can't do that to myself. And we try to remind them that the 30-year amortization is what gives them flexibility to make the decision as to how they want to make those payments.
Yeah, they can prepay. You got prepayment options and so on, 100%.
Exactly.
You can increase your payment 15, 20%, whatever the lender allows. You
There we
close
go.
and just increase your payment if you want. The good thing about that's an insurance policy, because if you increase your payment 15 or 20%, depending upon the lender, you can always go back.
Yep. I think a lot of
right?
people miss that. A lot of people miss that
So that's that
as well.
flexibility you talk about. So take the 30, increase your payment 15%. If you get into a tough situation, just go back. You can get rid of that
Agreed.
extra 15.
All right, so we're going to go back to some economic stuff, and there was an interesting report. I don't know if you saw this, Bruno. So it might be news to you. There was a survey from Consensus Economics. This showed up in my inbox this morning. An inflation forecaster. I'm sure you've seen variations of this, and it showed the consumer price inflation forecasts and GDP forecasts. Now, I don't know if you saw this specific one, so I might be sharing something pretty fresh with you at this point right now. But in short, consumer price forecasts go straight up and GDP goes way down. And that's essentially more or less what Canadians are saying could happen, or they believe that could happen right now. They think everything is going to go up in price, and they think that they're going to make less money, or we're going to be less productive as an economy over the course of the next few months/year. Now, that could be a serious concern, because the sentiment of Canadians has an impact on spending and real estate and so forth. So can we talk for a minute here, just briefly, knowing that we can never forecast exactly what's going to happen, but can we talk for a minute here as to what could happen in the real estate market in the next few months here if that became a reality? And second to that, once you've said that, once you've responded to that, would be, what would have to happen, or what would likely be happen for the market to rebound? So first, if this became a reality and we saw the cost of goods actually going up, or at least consumer sentiment thinks that, and GDP goes down, what would happen to the real estate purchase market, right? Well, you tell me your thoughts on that first and foremost.
Well, I mean, it's a very interesting question, because stagflation, and stagflation, for those of you that don't know, is the exact opposite of the dual mandate that the central bank wants. 2% inflation, maximum employment. Stagflation, the opposite of that, is high unemployment, high inflation. That would be the worst case scenario. And that hasn't happened since the 1980s. I mean, seriously, I think it's even the 70s. Stagflation was in the 70s. So for 50 years, we haven't had stagflation. Had you Googled stagflation 6 months ago, you might have gotten some stuff from 1970s. If you Google stagflation today, you're going to get multiple hits. And Goldman Sachs said that the Fed in the US had a very stagflationary feel. And why did they have a stagflationary feel, to your point? So the Federal Reserve came out, they held steady at 4.5% in the US. Their GDP forecast previously was 2.1, now it's 1.7. Their core PCE, which is the personal consumption expenditure, that's kind of what consumers pay for stuff, went from a 2.5 to a 2.8. Inflation going up, GDP going down. The Michigan Sentiment Survey in the US came in, and their expectations for inflation is an unbelievable 6.7%. And that's the battle we have, because if people think inflation is going to go to 6.7 and their cost of living is going to go up that high and GDP is coming down, again, they don't really want to make that decision right now, perhaps, in purchasing a house. I would always argue, you know what, you got to live somewhere. Are you renting? What are you paying for rent? I mean, when I bought my first house, the only thing I was thinking about is my son was just born. I was living in a little apartment in Toronto. I moved to Kitchener, 3 bedrooms. The baby crib was in the bedroom because I only had a 1-bedroom apartment. It was very small. But I was thinking, hey, there's a school down the street for when he gets to go to kindergarten. There's a park across the street for us to go to. There's a backyard for him to play in. I don't remember the interest rate I had, but I had to live somewhere. The apartment was obviously not conducive to raising a child, and I was given the opportunity to move to Kitchener. So when you're buying your house, and I'm talking about owner-occupied home, you always have to consider those elements and the payment. What's the monthly payment? What are my taxes? What's the carrying costs? And so on. I bought a newer home because I didn't want the headaches of an older home and potential repairs, roof, this, that. So because it was only my income at the time. So for people buying their houses, talk to a mortgage professional, see what you need for a down payment. Find out what the payment is. You might be surprised, because there was an absolute, as you know, in Q1 of 2022, there was like 50 offers on homes. People were going crazy, but the home prices were much higher. Like right now, just using that as an example, I mean, if we went back in, sorry, I don't have it, but
No problem.
the the prices, of course, were much higher um, at that time, right? So you had much higher prices. Prices have come down in most markets since Q1 of 2022. So you've got a lower potential down payment than you would have had back then when it was crazy. You have more shopping opportunity because the market isn't booming right now. So I think that in most markets, and I can't speak to all markets, but most markets, you have more of a selection. You have less down payment required. For a first-time home buyer now, you get a 30-year AM, so you can lower that payment a little bit more.
So do you believe in the idea that this like what's happening right now with the fear in the air? Because typically speaking, when there's a lot of uncertainty, people don't do anything, right? There's a lot of just like, hey, I'm going to sit and wait, right?
Yeah,
We've seen that forever. And
right.
this is happening again right now. And there's no doubt that we're seeing the amount of listings in the marketplace stack and stack and stack and stack, like record numbers all over the place.
Selection.
Crazy thing about that is we're actually
Lots
seeing
of
random properties go into multiples, which I can't
Right.
figure out. But the selection's high, the values are good relative to where it's been in the past, and you can purchase. And we are still seeing purchases. I mean, I was mentioning earlier that during the spring break, I didn't know it was 2 weeks, but apparently it's 2 weeks now. During that spring break period, we were busier than we've been in 6 months.
That's
Like it
good
was
news.
nonstop for
News.
purchases.
Good
But
news.
it slowed down again because of the fear. So my question to you is, do you think this is a situation here where we're kind of like, we've seen a little bit of stagnation in the market and we will continue to see stagnation for an extended period of time until something happens? Or is this just a bottling up of angst and you got a lot of folks out there who are just renting, waiting to buy, and they're going to jump back in once, you know, ideally this whole Trump thing and this election thing are all dealt with? Like, what are your thoughts on that?
I think when it comes to uncertainty, I think that it's usually, as you know, it comes out quickly, but then as time goes on, um, if things do stabilize to some extent and we don't get all this news every week, we seem to get these big headlines and these big things, and you know, tariffs last week, Liberation Day, and so on. But eventually, things may steady, and if you're still employed and you know 3-4 months from now, then you might start to see people start to consider getting back into the market because they've made it through the storm, so
Right.
to speak. Once things calm down, they might think, okay, well, you know, we're busy at work, things are happening. It's not like we're not busy. I got stuff to do, so my job is secure based on the business we're doing, whether you're working in manufacturing or in the services sector. And if you feel like your job is secure, then you can, you know, again, talk to a mortgage professional, and then we might start to see more sales because, you know, based on purchase price, based on the down payment, based on the 30-year AM that a first-time home buyer is now allowed, they might be surprised at what they're able to buy. Because remember, too, in Vancouver and in Toronto, you can buy up to 1.5 million with as a first-time home buyer. Now, of course, you got to qualify for the payments.
Anybody can. Well, a CMHC, right? Anybody with less than 20% down now can go up to 1.5. You
And a
hit on
30-year AM, yeah.
I'm interrupting you on this one point, but I want to riff on what you just said, which is if you think back, Bruno, to 2023 October, rates were around 6.25% to 6.5%. Now with them sitting from, you know, some sub 4% to 4.5%, anywhere in that range, we've seen interest rates drop over 2% in less than 2 years, which means that qualifying power has gone up 20+% in most situations, over 20%. And so for any first-time buyers who were not trying to qualify, you know, pre-2022 in the COVID era when rates were 2%, if they were looking last year and they looked this year, they might be shocked to realize I can borrow not 800, but maybe 900,000 or end with a 30-year amortization. Maybe it's more than that. And we're not saying that everybody should just go out and spend a whack load of money. It's not my point, but that little difference is getting people to a different point. On that, if I can riff for one more second here, I have seen more first-time home buyers with help, you know, albeit in some situations, but not as much as you think, be able to get into their first home being, especially in the suburbs, get into a townhome or a detached house than I had seen the previous 2 years before that. Like, yeah, there's people buying condos and stuff like that. Obviously, there's still folks out there doing that, but we're seeing a whole whackload of people where they're getting into their first single family home and they're willing to travel a little bit farther and do, or a townhome, which we never would have seen that 2 years ago or 3 years ago. We just weren't seeing it because that single family home was costing $950. Now it's $825. Plus they're making more money and they've saved more money and they qualify for more. And you know what I mean? But most people are just afraid to ask the question.
Right, and I do talk to a lot of brokers, and they're doing a lot of first-time home buyers in that $1.2 million. Why? Because previously you were kind of constrained to only a condo. Because if you're over $1 million, you had to put 20% down. These people don't have $250,000 to put down. They want to put down less, and they could be two professionals. They want to buy a house. They're paying extraordinary rent, and now they can get into, to your point, instead of a condo, they can now get into maybe a semi, maybe a townhome in the Toronto area, maybe in the Vancouver area. It all depends. I mean, you got to look at your market and see what's up for sale. But definitely it gives them that opportunity to get into a little bit more of a house, and a house that maybe they say, you know what, I get this townhouse, I can live here for 20 years. But if I get into a condo, you know, to my point, if you have a child, if you want to have another child, if it's only a 1-bedroom, I was able to get a 3-bedroom. But that gives you that opportunity for sure.
Yeah, I should preface by saying this was not happening
that you might want to live in for a longer time.
Agreed. I should make the point to say that's not Vancouver, downtown Vancouver, but we have seen a softening of that market too. So where you might buy a crappy one bed, now you're buying a nice one bed, right? Or you're buying a one bed plus den or something better than it was before. Either way, it's gotten better for Canadians, even though it's crazy to say this. A lot of people don't think so. And I think the reason that that's the case, unfortunately, is because of inflation in other areas of their lives, which no doubt are real. And that's a serious consideration. Now, Bruno, as we kind of look to the future here, we've got Bank of Canada updates coming in April and beyond. Every single week, we have seen different likelihoods of rates going down or going up. What would be, because this is going to come out right before BOC rate announcement. Let's go on record. Tell me, what is your prediction for April 16th from the BOC?
Again, I can't make predictions.
Come on.
Simply put, but I can look at the situation. So remember, the jobs numbers came out week on Friday. Okay, so the Bank of Canada sees those numbers. Inflation in the U.S. came in at 2.4, the lowest it's been since September of last year. That's good news, albeit that's rearview mirror stuff pre-tariffs. You have the carbon tax, I think, has been removed. I don't know effective when, but we know energy prices in Canada have come down just by filling gas and so on. Your price per liter has come down. So energy prices coming down will be a downward pressure on the inflation rate. So we just got to cheer for an inflation print of around 2%. And if the U.S. is at 2.4, maybe we can get in and around 2. So if we're in and around 2 and the Bank of Canada is comfortable that our inflation is subdued, given the job numbers, they will be considering that strongly. So I think the last time I looked, the market, which I can quote, and you can Google that, is about 2/3 prediction that the Bank of Canada will lower by a quarter.
Okay,
so I think that's
we'll
the last
that.
I looked.
We'll accept that.
Is it 66%, 65%? I think something like that there would be a quarter. I think that's what the market prediction was. I don't know. Don't quote me on it, but that is definitely some sort of consideration. But I mean, it's going to be interesting, and they announced that early in the morning. So out in BC, you'll get that announcement at around 6:45 a.m.
I know. You'll get the 4:30 wake up on those days. I got you.
you get to let your clients know. Now, the Bank of Canada has come down steadily. They haven't paused, although the U.S. has paused. And the U.S.'s next meeting is in the first week of May, and they'll be looking at all this uncertainty. So will the Bank of Canada lower because the job numbers were weak and inflation is subdued? The chances would be higher that they will lower, given those weak numbers are printed. They're done. They're weak. We lost like 32,000 full-time jobs in Canada, something to that effect, maybe more. I think it's all jobs. We only gained part-time jobs. So the jobs print that came out was weak on Friday. The inflation rate comes in low. The chances, I believe, of a cut, I'm not making the prediction of a cut, but they will consider those strongly when they make their final decision.
All right. Well, I think that it's pretty amazing that we just spoke for over half an hour and we didn't even talk about a Canadian election once. Kudos to us for doing that. All U.S. and all mortgages all day. Bruno, I mean, I'm grateful that you spend the time with us, my man. And if people want to find out a little bit more about Bruno, he's posting some incredible emails. If you're in the mortgage industry, you can reach out to Bruno and send us a message. We'll connect you with him and you can get on his daily digest with all of his good stuff. I can tell you from my end of things, I always appreciate when you take the time out to come on and join us. So thank you, Bruno, and cheers to the next one.
Yeah, here we go. Cheers.
All right.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.